All right, welcome everyone. This is a special briefing, and if you're a financial advisor, well, this one is specifically for you. Today we're going to cut through all the noise to explore the core utility of four key digital assets. And look, we're not talking about speculative trades here. We're looking at them as potential portfolio components that have distinct, evidence-based roles in this new economy.
Okay, let's just dive right in with a number, 3.6. So what is this number? Well, that's the total return your clients would see from a 20% annual growth rate, compounded over the next 7 years. Now, in the world of traditional finance, that's a legendary performance. In the digital asset space, it's a hurdle, right? It's a benchmark that's going to help us separate the real, foundational pillars from all the fads out there.
And that really brings us to the central question of this whole briefing. How can a portfolio realistically even target this kind of return? It's a huge challenge, and it kind of forces us to look beyond the usual asset classes, right? To seriously evaluate what these new ones can do. And that's exactly why we're here today.
So here's the game plan for today. We're going to start by really defining that 7-year hurdle we just talked about. Then we'll break down our 4 pillars one by one. First up is Bitcoin, then Ethereum, followed by the pair that works together, Solana and Circle. And then we're going to wrap it all up by looking at this through the most important lens for you, your fiduciary duty.
All right, first up, let's be crystal clear about our benchmark. We are setting a high bar, a 20% annualized return. Now, this isn't some wild prediction. Think of it as a performance hurdle, a standard we're going to use to judge the plausibility of each of these assets hitting that goal by 2033.
So, our first pillar is Bitcoin. But listen, we are not talking about the Bitcoin of 2017. You know, the super volatile speculative stuff. No. We're analyzing its evolved role, how it fits into today's landscape as the sovereign reserve asset of the entire digital economy.
I'm sure you've all heard the digital gold analogy, right? And, it's helpful for understanding the scarcity part. But Bitcoin's true utility has really grown up since then. What we're really talking about now is its utility as a sovereign reserve asset. What does that mean? It means it's becoming the foundational layer of value, the very bedrock for this whole new ecosystem.
And the evidence for this shift? It's all right here. First off, it's become an institutional bedrock. You're seeing it on corporate balance sheets, even in pension funds. It's being used as pristine, high-quality collateral. The halving events create this predictable supply shock that big institutional demand keeps eating up. And this is really important. It's not just sitting there. You've got new tech built on top of it, things called Layer 2s like Lightning and Stacks that now allow for complex things like payments and smart contracts, all secured by that main Bitcoin network.
Okay, so what does this all mean in terms of price? For Bitcoin to clear our hurdle, to actually hit that 20% annual return over the next 7 years, its price would need to land somewhere in the range of $320,000 to $350,000.
So what's the likelihood of that happening? We're putting it at high to moderate. And while that might sound high, for a lot of crypto-native funds and the big institutional research desks, that price target is actually seen as a base case, maybe even a little conservative.
All right, let's move on to our second pillar, Ethereum. So, if you think of Bitcoin as the digital gold, the reserve asset, then think of Ethereum as the world's asset layer. It's the global settlement platform where all that digital value is actually put to work. You might hear people call it the Internet of Value, and that's a decent starting point. But its real utility, its core function, is to be a world computer. It's a decentralized platform where developers can build all sorts of applications, and, this is huge for your clients, it's where real-world assets can be issued, traded, and managed on-chain.
So what's driving all this? Well, there are a few key things. First, some major upgrades have slashed transaction costs, basically turning Ethereum into the invisible plumbing that powers all these new apps. Next, it's become the tokenization powerhouse. I mean, you've got massive players like BlackRock choosing it to issue real-world assets. And lastly, it has this killer combination that institutions love. It's a major asset with a shrinking supply, and it also produces a native yield through a process called staking.
So for Ethereum to hit that same 20% annual benchmark we've been talking about, its price would need to get into that $8,000 to $11,000 range by 2033.
We're assessing the likelihood here as moderate. And you might be asking, why moderate? Well, it's because Ethereum has some pretty serious competition from faster chains. Its success in hitting this target really hinges on it winning the institutional yield market and becoming the go-to platform for all those tokenized assets.
Okay,
Now we're going to look at two assets that really work together. They form our third and fourth pillars, the layer for high-speed commerce and payments. And that's Solana, which is the network, and Circle, which is the regulated financial services company. The best way to get how they work together is to just follow the money. Okay, so it starts with merchants. They want payments that are instant and super cheap. Circle provides the what? A trusted, regulated digital dollar called USDC. And Solana provides the how? The high-speed rails that can settle that dollar transaction in less than a second for a tiny fraction of a penny.
When you think Solana, think one word, performance. There's a major network upgrade called Firedancer that's giving it the horsepower to handle the same volume as NASDAQ. I mean, that's huge. And that's exactly why it's become the main payment layer for big partners like Visa and Shopify, making it the undisputed hub for high-speed finance and consumer apps.
Now, Solana is definitely a higher growth, higher beta asset. So for it to clear that 20% hurdle over our 7-year time frame, it would need to hit a price target somewhere between $450 and $600.
We think the likelihood of it getting there is actually high. But, and this is a big but, it comes with higher risk. Solana is just more volatile. Now, if it really cements its place as the Visa of crypto, this return could be a major underestimate. But you have to know, the ride is going to be a lot bumpier than with Bitcoin or Ethereum.
Okay, let's talk about Circle. And the first thing to get straight is that we're talking about a stock here, not a token. It's a utility stock, and it makes its money from the interest on the giant reserves that back its USDC stablecoin. Its whole business is built on institutional trust and compliance, which makes it the perfect bridge for traditional banks. It's basically the regulated toll booth for this new digital economy. Now, because it's a stock, it's tied to more traditional ways of valuing a company. To deliver that 20% annual return, its stock price would need to get up to around $215 by 2033.
So, what's the likelihood here? We're rating it moderate to low. I mean, look, for any stock to sustain a 20% annual return for 7 straight years is incredibly rare. Its success is tied to business execution, what interest rates are doing, and the regulatory wins, not just the simple principle of digital scarcity. All right, let's pull all of that together and put it on one page. This chart really summarizes our whole analysis. You've got 4 distinct pillars, each playing a unique role. Bitcoin, the reserve asset, has a high to moderate shot at its target. Ethereum, the world's asset layer, has a moderate chance, but it does face some competition. Solana, the commerce network, has a high likelihood, but remember, that comes with higher risk. And finally, Circle, the regulated payment stock, has a moderate to low chance of sustaining that kind of growth because it's tied to so many traditional market factors.
And that really brings us to the final, and I think the most important question of all. We've gone through the utility cases and the potential returns. We've laid out the risks. So the question is no longer, is crypto a good investment? The question for you as a fiduciary is this. In a world that is starving for returns, and with this asset class maturing right before our eyes, is a 0% allocation still a responsible fiduciary decision? That's the real question you need to be thinking about.